All right, Andrew here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it is not theory, and it is not another financial news story you can scroll past. Between February 3rd and February 7th, 2026, 3 regional banks were quietly placed into what the FDIC calls informal receivership, not formal seizure, not public liquidation, informal receivership. And if you have never heard that term before, that is entirely by design. This is a legal mechanism that allows regulators to take operational control of a bank without triggering public panic. The bank keeps operating, the ATMs keep working, the online banking portal stays active. Your deposits are still there technically, but behind the scenes, every major decision, every loan approval, every liquidity deployment is now controlled by the FDIC. The institution holding your money is no longer independent. It is a puppet with regulators pulling the strings. And here is what makes this critical. This mechanism was not used once from 2010 to 2023, not during the European debt crisis, not during the taper tantrum, not during COVID. It was deployed twice in 2023 during the Silicon Valley Bank and First Republic collapse, and now it has been deployed 3 times in 5 days. That is not normal operating procedure. That is crisis management. And the fact that you have not seen a single headline about it on CNBC, Bloomberg, or the Wall Street Journal tells you everything you need to know about how this system works. They manage perception first and solve problems second. Over the next few minutes, I'm going to walk you through why these 3 banks were targeted, the 3 macro triggers converging right now, what this means for $4.2 trillion in uninsured deposits, and most importantly, what you need to do about it this week. First, you need to understand the concept that governs every banking crisis in history, the confidence cascade. When you deposit $100,000 in a bank, that money is not sitting in a vault. The bank loans out $90,000 of it and keeps roughly 10% in reserve. This works fine as long as everyone believes the system is stable. But the moment confidence breaks, if even 20% of depositors try to withdraw simultaneously, the bank does not have the liquidity. They start selling assets at fire sale prices. Losses mount. Confidence drops further. More withdrawals. This is the death spiral, and it has killed more banks than bad loans ever have. The FDIC was created in 1933 to break this cycle by insuring deposits up to $250,000. But here is what most people miss. If you are a business with $2 million in payroll sitting in an account, or a high net worth individual with $5 million in cash, the vast majority of your deposits are uninsured. You are an unsecured creditor of the bank. In a failure, you are in line behind the FDIC, behind secured bondholders, behind derivative counterparties. Your claim on that money is not guaranteed, it is conditional. Let that sit for a second. Now let us talk history, because the pattern repeats every single time, and most people do not recognize it until it is too late. In the 1970s, savings and loan institutions borrowed short-term deposits at low rates and loaned them out as long-term fixed-rate mortgages. When Paul Volcker raised the federal funds rate to 20% in 1981, the model shattered. These banks were paying 15% on deposits but earning 6% on mortgages. By 1989, over 1,000 institutions had failed. Cost to taxpayers exceeded $160 billion, close to $400 billion in today's dollars. The key insight is that the failures happened in waves. The weakest went first. Then confidence eroded. Depositors pulled money from similar institutions. The crisis spread. By the time the public understood what was happening, hundreds of banks were already insolvent. Sound familiar? It should. After 2008, the framework changed entirely. The Dodd-Frank Act introduced orderly liquidation authority, giving regulators the power to seize a failing bank, wipe out shareholders, impose losses on bondholders, and convert uninsured deposits into equity in a restructured entity. I need you to hear that again. Convert uninsured deposits into equity. Your cash becomes stock in a failing bank. This is the bail-in framework. It was tested in Cyprus in 2013. All deposits above €100,000 in the 2 largest banks were haircut up to 47.5%, converted into worthless equity. Depositors lost nearly half their wealth overnight. And this was not a rogue decision. It was coordinated policy, endorsed by the ECB, the IMF, and regulators of every major economy. It set the global template, and the mechanism is already in place in the United States under Title II of Dodd-Frank. Now let me tell you about these three banks and the profile that put them on the FDIC's radar. I cannot name them. Doing so could trigger the exact bank run regulators are trying to prevent. But I can tell you the common factors. All three are regional banks with total assets between 10 billion and 50 billion. All three have significant exposure to commercial real estate, particularly office buildings and retail properties in secondary markets, where values have fallen 30 to 50%. All three carry a high concentration of uninsured deposits from businesses, municipalities, and high net worth individuals. And all three have seen significant capital ratio deterioration over the last 6 months. Based on publicly available call report data, there are approximately 15 to 20 regional banks right now that fit this exact profile. Commercial real estate exposure above 300% of capital. Deposit outflows exceeding 10% last quarter. Capital ratios trending toward regulatory minimums. These are the institutions most at risk of being the next wave. Wyoming, three macro triggers are converging right now to make this critical. Trigger 1 is the commercial real estate maturity wall. Over $1.2 trillion in CRE loans are maturing in 2026, heaviest in Q2 and Q3. These loans were originated when rates were near zero and property values were at highs. A borrower who financed at 3.5% on a $10 million loan now faces 7 to 8% on a refinance. And the bank will only lend against today's appraised value, not the original. So instead of refinancing $10 million, the borrower qualifies for $6 million. They need $4 million in cash just to keep the property. Most do not have it, so they hand back the keys. Strategic default, rational for the borrower, catastrophic for the bank, which now owns a property generating negative cash flow and must mark the loss immediately. Trigger 2 is the duration mismatch in bond portfolios. Regional banks hold massive positions in treasuries and mortgage-backed securities bought when rates were low. Those bonds are now worth significantly less than face value. If held to maturity, no loss. But if the bank needs to sell them to meet deposit withdrawals, the loss becomes real instantly. SVB collapsed in 48 hours from exactly this mechanism. Right now, across the entire US banking system, there are over $600 billion in unrealized bond losses, hidden on the balance sheet, invisible in reported earnings. But the moment deposits start leaving, those paper losses become real losses, and capital evaporates overnight. Trigger 3 is the depositor migration. With the Fed funds rate above 4%, depositors can earn meaningful yields in treasury bills, money market funds, and high-yield savings accounts. They are not panicking. They are simply moving money to where it earns more. But for regional banks that relied on sticky, low-cost deposits for decades, this is a slow-motion bank run. Deposits leave. The bank borrows at higher rates or sells assets at a loss. Profitability collapses. Capital deteriorates. These three forces are converging simultaneously in Q1 2026. That is why the receiverships are happening now, and the pace is accelerating. And understand, again, the US banking system has roughly 4,600 commercial banks. About 30 are too big to fail. About 100 are large regionals. The remaining 4,500 community and smaller regional banks are the most vulnerable. They are concentrated in commercial real estate. They carry high uninsured deposits. They lack access to wholesale funding. When stress hits, these break first. In the S&L crisis, small thrifts failed first, then mid-sized, then larger regionals. The pattern is always the same. Cracks at the periphery, then propagation toward the core. 3 receiverships in 1 week is not a systemic crisis yet, but it is a very loud, early warning signal. Let me walk you through the 3 scenarios for what comes next. Scenario 1 is managed consolidation. The FDIC engineers mergers between troubled banks and healthier acquirers. Depositors are made whole. Best case. The problem is there are only so many healthy banks willing to buy. Scenario 2 is orderly liquidation. Bank seized on a Friday. Insured depositors get money back Monday. Uninsured depositors get a receivership certificate and eventually recover 50 to 80 cents on the dollar. Scenario 3 is the systemic bail-in. Under Title II of Dodd-Frank, uninsured deposits are converted into equity In a restructured bank, you do not get cash. You get shares in a failing institution that may be worth a fraction of your deposit. Or nothing. This is the Cyprus playbook, and it is already law in the United States. Given this, here are 3 asymmetric plays to protect your wealth and potentially profit from the dislocation. Play 1 is physical precious metals. Gold and silver carry zero counterparty risk. When you hold physical metal, there is no bank, no clearinghouse, no government entity that can convert, freeze, or haircut that asset. Central banks bought over 1,000 tons of gold in 2025, the highest sustained level in 50 years. They are telling you with their actions what they will never say publicly. The move is 10 to 20% of liquid net worth in physical metal held outside the banking system. Not ETFs, not futures. Metal you control. Play 2 is distressed credit. When banks liquidate, they sell assets at 50 to 70 cents on the dollar. Senior secured loans with hard collateral backing. Investors who positioned in distressed credit during the S&L crisis in 2008 generated 20 to 50% annualized returns over 5 years. But you must be positioned before the liquidation begins. Play 3 is jurisdictional diversification. Do not keep all your wealth in one country, one bank, or one legal structure. Spread deposits across multiple institutions to stay under the $250,000 FDIC cap. Consider offshore banking in jurisdictions like Switzerland or Singapore with stronger, more conservative frameworks. Here is your action checklist for this week. First, audit every bank account. If you have more than $250,000 at any single institution, you are holding uninsured deposits at risk. Move funds or reallocate. Second, check your bank's health. Call report data is public. Look at CRE concentration, unrealized losses, deposit trends, and capital ratios. Deterioration in any of those is a red flag. Third, establish physical precious metals. Minimum 10% of liquid net worth. Reputable dealer. Take delivery or allocated storage. Bullion, not collectibles. Fourth, explore offshore banking if you have significant wealth. Fifth, stay informed. The next 60 to 90 days will reveal the true scope of this stress as call reports come in and CRE maturities accelerate. Here is my question for you. Do you currently have more than $250,000 at a single bank? What is your plan? Drop it in the comments. The collective intelligence of this community is one of the most valuable things we have built. If this breakdown opened your eyes, hit subscribe and turn on notifications. Share this with anyone who has significant deposits in regional banks. The people who are going to be hurt most are the ones who do not have access to this information right now. The receiverships are happening. The pattern is accelerating. The only question is whether you recognize the warning signs in time. Stay sharp. I will see you in the next one.